guys, welcome back to my channel and don't forget to like, comment, share and subscribe. US job growth surged much more than expected in July and the unemployment rate ticked lower, giving the Federal Reserve enough caution to stay on its aggressive rate hike path as it tries to tame inflation. Non-farm payrolls increased by the Labor Department's employment report showed on Friday. June was revised upward to show payrolls rising by instead of the previous reported. Economists followed by Reuters had forex job added last month. Employers continue to raise wages at a steady pace last month. Average hourly earnings increased 5% in July after gaining 4% in June. That increased the year-on-year increase to 5% from 5% in June. It's a blockbuster number. It really clears the path for the Fed to continue with the hawkish viewpoints that have been expressed recently that they need to continue to really press on inflation. I think a 75 basis points hike in September is most likely. We have a real supply demand imbalance in terms of the labor market. There was a strong urge for people to call the all clear on inflation, and we're just not there. Is becoming more evident and it's actually accelerating, not deceleration. It's what we've feared, which is that the labor market is going to take much longer and much more Fed action to cool down than expected. That means there's not going to be a Fed pivot anytime soon. The pivot party is now over. They're not going to cut interest rates in the first half of next year as the market had hoped. Every metric was hotter than expected. Top line wage growth accelerated and unemployment fell. Average hours rose, showing more demand for labor. That participation rate fell. That means you have less workers, more demand, and therefore higher wages. The parted much too hard coming into this number, and there's going to be a hangover. This is a much stronger report than was expected. What it means is the Fed cannot pivot at this point. The Federal Reserve has to continue to hike rates. The folks who are saying let's take it more slowly are being shoved as it here with this report. That said, it's not quite as strong as what was suggested by the headlines. This suggests, among some other data, that the US economy is not in a recession. To me, it doesn't necessarily confirm that one will ultimately be avoided. But yes, this is a really strong number. But I think the market is going to reach to it to it today that maybe the Fed goes ahead with 75 basis points. We can't forget about next week's CPI prime. That will be really important to determine how the Fed views the economic data over the past week because if inflation actually did peak and it comes down in the July report from say 9 to 8, then that's then that's the case scenario. You have inflation coming down, the economy holding up, that in theory should increase the odds of a softish landing. We can't just strip out the employment reports from the inflation report. They need to be viewed together, particularly with it being such a critical moment in determining Fed policy. Today's number is extremely impressive and is another reminder just how strong this economy is. It likely is telling us that the hacking the Fed is doing, the economy is withstanding it, surprising many who thought the economy would weaken. You have to be impressed with the resiliency of the US economy once again. Okay, maybe that's all from me. Thank you for watching and don't forget to like, comment, share and subscribe this channel. Thank you.